Good morning, everyone, and welcome to our first quarter's fund manager workshops. I'm really excited about today. We've got some insights from our local managers that we're hoping to share with you from right across the risk spectrum of our fund range. Our aim today is to give you the opportunity to listen to what our fund managers are thinking about the market, to touch on some of the topical investment themes and risks, and really for you to come away with an understanding of how your managers are managing your or your clients' money through this period. My name's Doug Nicol, and today I'm joined by my colleague David Levinson, and we'll be taking you through the proceedings today. We currently coming from our Cape Town offices, and it would be amiss for me not to acknowledge the fires that have taken place on the Cape Town mountain, and we do send out our best wishes to those who have been impacted and those who continue to fight the fire. 2021 has been quite an interesting start to the year. We've seen South African equities, particularly commodities, continue their strong rally, but more interestingly, SA Inc. has staged somewhat of a recovery. The rand has rallied hard against the dollar, and we've had some good news on the fiscal front with some additional collections in taxes as a result of the commodity boom. But there's still significant risks that remain. Inflation's still a concern. The South African fiscal risks are still there and haven't disappeared. And our vaccine rollout has obviously been delayed. So we hope that through this day's proceedings that our investment managers will touch on each of these topics and really just give you some understanding about how they're managing through some of these issues and opportunities. Our first speaker today is Sharika Salie. She is PM at Taquanta, and she manages the Core Income Fund. The Core Income Fund is a very low-risk fund. It's very much focused at the type of investor who has a very low risk tolerance and cannot really sustain a drawdown in their fund particularly over 1 to 3 months. And today she's going to be taking us through a presentation about how she managed her fund during 2020 and how she positioned the fund to outperform cash. So Sharika, I'm going to hand over to you to take us through some of your insights from last year.
Okay, so I'm going to be discussing cash management during a pandemic. So let me just move to the next slide. Here we go. I'm starting off with the key themes of 2020. SA was caught in the midst of a severe liquidity crisis in March. Globally and locally, assets came under huge strain as the coronavirus spread around the world. Just to give you an idea, the JSE market cap at the beginning of 2020 was 15 trillion rand, and it plummeted to 12 trillion by the end of March 2020. That was 3 trillion wiped off the exchange, value destroyed. Liquidity was drained from the money markets thanks to increasing margin calls and algorithm-triggered selling. I mean, the JSE itself came out and said that the margin calls that took place at the end of Q1 were unprecedented and at exorbitant levels. The effects of the South Africa's sell-off was magnified by an economic recession and a credit rating downgrade to junk status by Moody's credit rating agency. This triggered South Africa's expulsion from the FTSE World Government Bond Index. As you can imagine, credit spreads and bond yields soared. Towards the end of March, some local banks struggled to access short-term funds, and as a result, the SARB raised credit lines to cash-strained banks. The SARB also reduced rates by 125 basis points in Q1 to provide some relief to the economy. In Q2, the SARB introduced further rate cuts amounting to 150 basis points to provide relief to businesses and consumers. In addition to various liquidity support measures, the SARB also provided further aid to the banking sector in the form of regulatory capital relief. As lockdown played out, piles of cash started accumulating with the banks due to the lack of economic activity and increased savings. At the same time, the SA collective scheme industry saw record investments into interest-bearing unit trusts. 68 billion of new money entered this market. The record investment in unit trusts came as a big surprise to the market, and because we were shocked. There was a lot of volatility and uncertainty at the time, so no fixed income manager was expecting this. In quarter three, the SARB provided relief to the economy again in the form of a 25 basis points cut in July. To date, this has been the last change in interest rates. In this time, the market also started to feel the effects of all the excess cash in the system. On the one hand, you had banks not lending thanks to muted demand for credit, and they were sitting on large cash balances. On the other hand, you had 68 billion of new money entering the CIS markets looking for assets to buy. Fixed income managers were sitting on record amount of cash, and there were very little assets available. As you can imagine, this demand and supply imbalance sent credit spreads into a freefall. Despite all the volatility in 2020, the fund experienced no negative months. This is testament to our investment philosophy centered around capital preservation. The fund continued to outperform its benchmark STEFI Composite Index. This was due to the careful management of counterparty risk, instrument risk, interest rate risk, and most importantly, liquidity risk. With every decision we make, when we allocate clients' capital, we carefully consider our ability to manage these risks. This chart simply shows that the longer your investment time horizon, the more alpha we can generate through the extraction of the liquidity risk premium. As one moves further right, clients' investment time horizons get longer and cash flows become less volatile. And for that, you get a premium. So if you go from a call deposit to a money market fund, your premium there is 1.25%, a money market fund to an enhanced cash portfolio like the core income fund, your premium there would be 50. From a core income fund type mandate to a custom core mandate. By custom core, that's just a segregated portfolio where we have a one-on-one relationship with clients. So cash flows are more known. You get an additional 40 basis points, and then you get the enhanced income mandate, also known as, high yield funds. There you get a 2% increase in premium. So what is term premium and liquidity risk premium? So term premium is simply the difference between what you get for locking up your money for an extended period and what you get by if you simply kept the money in a short-term instrument. So because the future is uncertain, investors get rewarded the longer they invest. So as you can see on the slide, term premium, same bank, same instrument, all tradable instruments, similar interest rate risk, different maturity. Then we have liquidity risk premium, and that's simply the additional interest investors demand or should demand for less liquid instruments. You cannot, for example, price an NCD and a deposit in the same way. NCDs are easily tradable and they can easily be liquidated. You can get your cash same day, and you can sell it in massive volumes. I mean, I've sold NCDs to the tune of 8 billion in the span of 3 days, and I easily got my capital and interest back. Whereas deposits are completely liquid. So if I wanted to get out of a deposit, you can't sell it. It's not tradable. It's in the name of a fund. I can't sell it to another fund. I can't sell it through a broker. So for that illiquidity, investors should demand additional yield. So a lot of investors see an instrument issued by a bank and they assume all bank debt is the same. That is not true. Banks can issue various types of debt with different liquidity profiles and different levels of capital risk. The type of debt we buy into the NGI Core Income Fund is senior ranking debt only. Banks also issue subordinated debt such as Tier 2 and additional Tier 1, which falls under capital. So Tier 2 capital is currently trading at a 200 basis points premium over senior debt, and additional Tier 1 capital is trading at 400 basis points over senior bank debt. But here your capital is potentially at risk in times of incredible stress, as these instruments are loss absorbing, which means a bank can call on these instruments to stabilize itself, and to protect senior ranking debt holders. The point I'm trying to get across is that the higher the returns, the higher the risk. For the same level of credit risk, interest rate risk, liquidity risk, you can't magically get this higher return. So you need to understand where your returns are coming from. So if we look at the chart on the left, we can see that banks fare better in times of uncertainty and are less volatile than other types of credit. The recovery of senior financial instruments and even senior subordinated instruments have been much more pronounced and quicker than that of, for example, corporate debt. And SOE debt, as you can see, still remains out of favor for obvious reasons. On the right-hand side, we have a chart showing senior bank instruments versus sub-debt instruments. And I put this in here so that you can see how this type of debt behaves in times of stress. That's the red bubble, which is the COVID liquidity crisis. And there you can see Tier 2 and additional Tier 1 instruments are very volatile. I know for a fact that some income funds that held these instruments went into negative territory during that period. The yields on these types of instruments spike dramatically, and it is very hard to sell these instruments in times of uncertainty and when the market is risk averse. This over here speaks to the evolution of bank spreads throughout the pandemic. So credit spreads in the local market have been tightening since 2017. However, the credit spread cycle turned abruptly in March 2020 as SA went into lockdown and fear and uncertainty was gripping the market at that point in time. We believe we were in a unique position during the start of the COVID liquidity crisis because we were sitting on higher levels of liquidity due to our view earlier in the year that the Moody's sovereign downgrade would occur in March, and hence we de-risked our cash portfolios and income portfolios in terms of liquidity and credit, and we did that in December 2019 already. Market liquidity dried up completely towards the end of March. The only instrument that you could trade at the end of March to generate liquidity was a vanilla bank NCD. As uncertainty grew exponentially starting from mid-March, every week got more uncertain than the week before. So bank spreads widened significantly, and the fund benefited from this as we purchased bank NCDs at a favorable spread during this period because we were sitting on loads of cash. So this was a lovely buying opportunity for us. The fund opportunistically purchased new as well as secondary bank paper towards the end of March, as well as in April and early May when bank spreads were at their highest. This bode well for the fund, and investors were better rewarded for the risks they were taking. Towards the end of May, market spreads declined rapidly due to the complete lack of demand for credit in the economy. So banks, as I was saying earlier, banks were not lending, and we had all this money, fixed income managers, we had all this cash we were sitting on, and all of us were, trying to buy the same asset, and spreads just started, plummeting to extremely low risk-adjusted levels. You can see a one-year NCD went from like JIBAR plus 117 basis points to JIBAR plus 17 basis points. So, investors in this time period, I would say from August, September, and October, even the first 3 quarters of November, they were not being rewarded for the risks that they were taking. And that is thanks to that demand and supply imbalance we spoke about earlier. And then we had to look for alternative to bank paper. As you know, banks are one of the biggest issuers in the market. So, the NGI Core Income Fund is a 70 billion rand fund. So we had to look for alternative assets in size. And that's why we started turning to treasury bills, because what we saw was that treasury bills were actually paying up in excess of 50 basis points above where the banks were issuing. So we found a safe haven in those type of assets. Okay, so if we look here, the opportunities in 2020. So despite muted bank spreads for that period of August and November, there was acceptable alpha in SA government bonds. But these, unfortunately, as is, are high duration instruments, and they carry significant interest rate risk. And our philosophy is to strip out interest rate risk. Yields, however, were compelling, so we chatted to various banks on structuring the R186 government bond into a floating rate, low duration, fixed income instrument that paid a significant premium over bank paper. It took us about a month to get the legal wording and the structure right, but after much work, we finally got it perfect and both parties were happy, and we executed on this trade. If I look at the outlook for 2021, looking ahead, the expectation is for short-term interest rates to recover from current levels. The magnitude thereof depends on, obviously, the source. So you can see in green, we have the FRA implied expectations. In orange, we have the Taquanta Asset Manager expectations. And then in orange, we have the Bloomberg median forecast, which is basically Bloomberg polling various economists in the market. And the key driver to this interest rate outlook is the recovery in global inflation cycles. So expansionary global fiscal policy and the lifting of lockdown restrictions are set to be growth positive, especially coming from a low production base. A successful implementation of the COVID-19 vaccine rollout program, as well as strong immunization, can further improve economic activity through anchoring policy and business confidence. In the short term, we foresee this resumption in economic activity to outpace spare capacity as global demand for final products looks to outweigh the supply of capital goods. So you can see, for this reason, global oil prices have increased by 37% in rand terms already in the first quarter of the year, while electricity costs have been confirmed to rise by approximately 16% from the second half of the year. A build-up in global savings from the rise in cash investments is also likely to decrease the more certain policy and political expectations become. This decrease in savings should benefit production assets, improve capital expenditure programs, and increase the labor participation rate down the line. The short-run phenomenon of a low base effect inspired growth path and slow improvements in the labor market have made our short-term interest rate outlook less aggressive relative to that of the forward rate agreement market. On the other hand, a surge in fuel and electricity costs, as well as their knock-on effects to the wider consumer price index basket, makes us moderately more aggressive versus the Bloomberg peer median forecasts. So the final slide, the investment philosophy of conservative credit selection and low duration continues to support returns in the fund. The fund has a bias towards floating rate instruments, which bodes well for the future returns in the fund given the general interest rate view. While we look for opportunities, we remain prudent around credit, and we continue to manage the liquidity and maturity risk as efficiently as possible. Thank you very much.
Thanks, Sharika. That was great. I guess there's no free lunch in the market, and as Sharika has explained, for the core income fund, the way that they try and achieve that additional cash enhancement is through taking slightly longer term risk in the types of notes that they're going for, but obviously with the key consideration for protecting capital over very short periods of time.